Hello guys, welcome to i-tutor Academy. In today's session, we will start with the Unit 3 subsection 4 Revenue and Expenses. Let us now learn what constitute revenue and expenses during an accounting period. Moreover, we shall also try to answer the following questions. Does a business only earn revenue from sales? Are there any other sources of income for a business entity? Revenue. Revenue is simply described as the income generated by a business from the sales of goods or provision of services during an accounting period. Revenue is also commonly referred to as the sales revenue or gross revenue. However, there are certain activities which are incidental to the main operation of the business. The revenue that accrues from such a non-operating activities is known as non-operating revenue. Example also there. And expenses. Expenses refers to the cost incurred by a revenue business firm to generate revenue during an accounting period. It is a revenue expenditure incurred for running the business operation, and its benefit is only limited to the current period. Expenses are generally of a recurring nature, such as salaries, rent, interest, etc. Moreover, capital expenditure such as purchase of fixed asset is not treated as an expense, as the benefit of a fixed asset continues for more than one accounting period. As already discussed, a cost becomes an expense when it recognizes. The recognition of expenses occurred at a point where the corresponding revenue is realized. Rent of the office building due for the current period is an expense of the current period, even if the actual payment of revenue is made during the next accounting period. And this is period are called outstanding expenses. And prepaid rent related to the next accounting period paid during the current period is not an expense of the current accounting period. It will recognize as a expense in the next accounting period when it becomes due. Inventory is treated as an expense in the accounting period during which it is sold. Thus, the remaining unsold inventory or closing stock is not treated as an expense because it did not generate revenue during the current accounting period. In other words, an expense is that part of the cost that has expired and been used up by activities directed at generating revenue. Therefore, all expenses are cost, but all costs are not expenses. And there are two important classification of also expenses: direct and indirect expenses, operating and non-operating expenses. Direct and indirect expenses. Direct, as the name suggests, are those expenses which are directly related and allocated to the core business operation. Mainly, these are the expenses involved in purchases of inventory and manufacturing or production of goods or services. On the other hand, indirect expenses are not directly related and allocated to the core business operations of a firm, such as production. Indirect expenses are incurred to run the business operation smoothly. Operating and non-operating expenses. Operating expenses are the expenses incurred for running the business operations but are not directly related to the core activities of production or trading. And non-operating expenses are expenses incurred on non-core activities. These expenses are not related to production or sales but are incidental to the business operations. And few examples also there. And one activity is there, you just fulfill this activity for your preparation. It's based on above content. And few important concepts also there. First one is cost of goods sold. And there is cost of goods sold is equal to opening stock price purchase plus direct expenses minus closing stock. This is the definition of cost of goods uh, sold. And illustration also there for the you just go through your IGNOU material. And inventory valuation. As discussed, assets are recorded in the balance sheet at the cost price at which they are purchased. Similarly, inventory is also valued at a cost. The challenge here is that the cost of inventory purchased doesn't remain constant over a operating cycle. And first in first out, that is FIFO. This method is based on the assumption those material or inventory purchased first are issued first for production process or sales. Hence, they are priced at the cost of oldest material or inventory listed in the store's ledger until all units of the oldest batch are used up, and last in first out LIFO. In the contrast to FIFO and LIFO is based on the assumption those material inventory purchased last in order are issued first of production process sales. And here is illustrations are there. Illustration 2, first in first out method also illustration is there. So you just go through it, and in case any doubt you can contact our contact number. And closing stock also there. Closing stock is equal to opening stock plus purchases minus cost of goods sold. And depreciation, as already discussed, fixed asset are the one having a useful life of more than 1 year. They provide benefit to the business in the long run and thus are bound to suffer some wear and tear with the passage of time. Depreciation is the gradual decline in the value of a fixed asset over its useful life due to use, wear and tear or obsolescence. And here is the methods also. There are various methods in calculating depreciation. So straight line method and written down value method. Now we shall discuss the basic terminology of depreciation. Original cost of the asset. This is the cost at which the fixed asset has been purchased and made available for use in the business. Salvage value, it is the expected recovery or scrap value of the asset at the end of its useful life. Useful life, the time period that is in year for which the asset is expected to be used for the operations of business. And depreciable cost, it is the net cost after deducting the salvage value from the original cost of the asset. This is the cost of asset to the depreciation during its useful life. Some portions of depreciable cost will expired and treated as an expense each year until the useful life of asset. That expired cost is known as depreciation. Book value, the original cost of the asset less its depreciation to date. Accumulated depreciation is known as the book value of the asset. This is also referred to as the written down value. And bad debt also there. Just go through your material. And provisions for doubtful and bad debt. Income tax provisions for tax is there. So these are the some basic concept for this accounting. So you just go through your material. If you have any doubt, you just contact our contact number, or you can comment it on our comment box also. Next is profit and loss. So far we have learned about the various revenue and expenses arising during the course of business operation and shown in the trading and profit and loss account. Broadly, we understand that profit is the excess of revenue over the expenses recognized during a fiscal year or accounting period. Conversely, loss is the excess of expenses over revenue realized during a fiscal year. However, the significance of dividing income statement into trading and profit and loss account lies in the presentation of gross profit and net profit respectively. Besides, business entities are also interested in ascertaining the profit arising solely from business operation, referred to as a operating profit. And gross profit is equal to sales minus cost of goods sold, and gross profit is ratio is equal to gross profit divided by sales into 100. Gross profit or loss is transferred to the profit and loss account. And operating profit is equal to gross profit minus operating expenses including depreciation or amortization. The idea is separate the income earned from production and sales from the other non-core activities of business. And next, net profit before tax. The net profit before tax is the surplus of all business income, overall expenses including interest but excluding tax. This is the profit available to the business entity, a result of both operating and non-operating activities. Net profit is equal to gross profit plus other business incomes minus indirect expenses, that is excluding tax. And next is net profit. Net profit is simply the amount which is available to the business for appropriation. It is the net income from both operating and non-operating business activities after reducing the both direct and indirect expenses. And there is retained earnings also there. Okay, and activity also there based on the topic. You just go through it. And the income statement is there. The balance sheet represents the summary of the asset, liability, and net worth of the business at the end of an accounting period. In a way, it summarizes the net effect of business operations and transaction made during the accounting period. However, it does not disclose anything about the business operations. What was the sales volume and revenue? How much direct and indirect expenses were incurred? What was the amount of operating and non-operating income? How many purchases of raw materials were made? All these answers are in fact addressed by the income statement of the business. Income statement is also commonly referred to as profit and loss. It discloses the business revenue, cost of goods or sold, gross profit or loss, selling and administrative expenses, other non-operating expenses and income, tax paid, and net profit loss in a coherent and logical manner. The profit or loss is determined by taking all income and subtracting all expenses from both operating and non-operating activities pertaining to an accounting period. For a systematic determination of gross profit or loss and net profit or loss, income statement is divided in two sections, namely trading account and profit and loss account. So this is about today's session. Next section of this unit 3, preparing a trading and profit and loss account, we will discuss on next video onwards. And for more content of MBA, you just do like, share and subscribe our channel. And thank you so much.
i-tutor ES presents IGNOU MBA, complete syllabus coverage classes and individual semester base, subject coverage program for MBA students, online and flexible sessions. For more details, contact 62382 1788.